All right, here we go. Rock and roll. Happy Tuesday. We'll let everybody come on in here. We'll give it just a minute. I wish I had some background theme music. I think I need theme music for these things as we kind of do these in the future. So awesome. Everybody's starting to come on. How's everybody doing? You are having access to the chat. So when you're in there, chime in where you're from. You from California? Are you East Coast? Are you maybe in Nevada? Or are you elsewhere? So chime in the chat. You should have access to it. Denver, Colorado. All right. One person wants to chat tonight. All right, everybody else is coming in. Very cool. Yeah, chime in where you're from. If you're Midwest, East Coast, West Coast. San Luis Obispo. Beautiful. Love it. San Diego. Love it. Cool. Well, everybody come on in. So this is going to be really awesome tonight. A couple of things that are going to be unique that we have not done before. Number one, I'm going to actually be showing you two deals that recent mentees in our program have gone after. And so I'm going to show you. So we have them submit their numbers to us typically, and then we will help them review those numbers prior to actually making offers, just to double check it, especially if they're brand new and just learning. So they'll submit the deal analyzer. Our team will actually analyze it alongside them, give them our feedback before they're making offers on things. So it's actually pretty cool, and they give a nice experience. But I'm going to kind of go through two deals, two separate ones that we recently analyzed that they've gone after. So it should be pretty awesome. Dallas, Fort Worth, beautiful. I just literally flew back today. I'm like losing my mind. San Antonio, Texas. So I know Houston's getting blasted with the storm. Anything happening in Dallas, Texas? I was down south. We were fine in San Antonio, but I'm curious. Nothing. Okay. Yeah, if anything happened in Dallas, you let us know. Beautiful. Yeah, thanks for everybody coming on. A little bit of wet weather. Great. Okay, here we go. Can everybody hear me okay? Just put a little thumbs up if you can hear okay and that the audio is good for us to go. We're actually in our new studio. It's not finished yet, but we're getting it going here. So you got a little handling and lighting and all that stuff. We have a brand new podcast studio and office and everything that we've launched. So in the weeks coming, we'll start to unveil that. But perfect sound. Okay. Yeah, we're using a specialized mic that's hanging above us right now. So it's picking up the audio and stuff. So I'm glad that that's working. Okay, let's go ahead and get started. So what I want to touch on is a few things tonight, because I keep hearing it when I get on calls and I talk to people that are considering multifamily, considering real estate investing in general. And the constant thing I hear over and over and over again is, how do I find deals? How do I handle the financing and capital? How do I find deals? How do I do the financing and capital? And those are typically the roadblocks, right? There's the analyzing part. There's the closing of the escrow part. There's the management. Those are all fine, key pillars to buying an apartment building. But constantly, it's how do you find the deals that actually make sense, especially in this environment? And how do I do the money side, the financing from the loan to the equity, the down payment? How do I put it all together, structure it, and make it happen? So we're going to be going through all that this evening, and I'm going to actually showcase a couple case study deals. I'm going to show you the analyzation I've done for some mentees in the program, the deals they sent us, and so forth. So we're going to go through that real quick. Let's get started. How to buy an apartment building in 90 days. How can you do this? Okay, how can you do this? Have you ever heard the quote, the only thing keeping you from where you're at and where you want to go is 7 inches? And do you know what the 7 inches is? And no, it's not what you think. People's minds. Chime in. I'm curious what you think the 7 inches is. Yeah, you're getting a laughing emoji. I get it. Your mind was going dirty. Don't do that. Between your ears. There you go, John. Love it. Yeah, it's the 7 inches between your ears, right? We tell ourselves such BS stories in our minds as to why we can and can't do things. And we do it every day. I'm guilty of it. You're guilty of it. We're all guilty of it. And so getting over those limiting belief systems is so critically important if you're going to do anything or have any major impact in life. It's critical, okay? It's critical. So Everything you want is just outside of your comfort zone, and you have to be able to get your mind right and kind of blind yourself from the 7 inches between your ears that's telling you crazy stuff. Because if you don't do that, it's going to be very difficult to make great strides. Would you agree with that? Chime in there. And then I'm going to go ahead and put up one of the poll questions I have. I can actually get to it here. There we go. I'm going to launch this one. See if this comes in here. Can you see this in your poll that you guys can answer? Why are you here tonight? Why are you here tonight? Is it coming up for you? You want passive income? Beautiful. Build a retirement, generational wealth. You can select multiples, right? It doesn't have to be just one. I want to get out of the single family investing and into the bigger game of apartments. Love it. Yeah. Scale big, become a multimillionaire. I think we all do. I'm still trying to win the lotto. Hasn't happened yet, unfortunately. All the above. Yeah. Beautiful. Love it. So I'm going to end that one. I'm going to share those results with all of you so you can see that. And there you go in the chat. Okay. Have any of you seen this before? Has anybody ever shown you, and this goes into the mindset side again, the 7 mountains that move a nation and inspire people? Thumbs up, thumbs down. Have you ever seen this before? Okay. Because we're going to go through them, and I want you to pick the ones that are important to you, because it's going to be really critical for you going from where you're at, where you want to go in the apartment space. Okay. Sports and culture, family, media, government, business, education, and religion. Right? Sports and culture, family, media, government, business, education, and religion. Which one of those, take 3 to 4, and which one of those are most important to you? And put that in the chat. I'm curious. Is it business? Is it media? Is it family? Is it government? Education, religion, sports? Love it. Okay. Awesome. So I did this exercise last year in September when I was actually at a Patrick Bet-David conference. And this is where it came up from him. If you know who Patrick Bet-David is, I was down at his conference. He brought it up. Okay. And I had to come up with mine. Like out of those 7, okay, which one were important to me? So hands down business, right? You have to have a successful business in anything that you're doing, because that's going to help drive the capital, the money to then do other things in your life. It's going to give you the choices to do it. Okay. So business is critical to me. Then we had the media side. Okay. I don't know why it's doing that. That's weird. Oh, there we go. Technical difficulties. Perfect. Okay. I don't know why it wants to do that. That's weird. We're going to delete that guy. There we go. Okay. So media and business were definitely my 2, the big ones. And then I also had family, and I had education. Those were huge ones for me too. So by having a successful business, by doing all of that, then I can go into the media side to help amplify that. Then we can go into the education side, which is helping all of you and anybody that's interested in learning the multifamily. Then on top of that, we can come, and family is philanthropy. It's not just your personal family. It's also philanthropy, helping others, giving back. So for me, it's all about the Steel Future Foundation, Tunnels to Towers. They pay off the mortgages of first responders and soldiers around the United States that were active duty. All of that, helping kids and mentoring students and kids that are in bad situations. These are all passions of mine. And by having successful businesses, leveraging media, then getting into education and using the family, which is the philanthropy and personal family, those are my passions. So that way money is not the main driver, right? Money will only get you so far. Then you need to have things that are going to get you out of bed every single morning and push you and drive you. Would you agree with that? Awesome. Love it. So I want you to pick out, as we kind of go through this evening, and think about these things for you. Because if you're trying to buy your first multifamily deal, if you're trying to buy your 10th one, if you're trying to go big, I don't care what you're trying to do, you can't be driven just by the money. The money is simply a choice to get there. It's a game. But you have to be driven by these things, right? Sports and culture, family, media, government, business, education, or religion, right? And one of the 7 or a combination thereof, but pick 3 to 4 and nail those down tonight. So you have those for yourself and why they're important to you. Okay. Awesome. So let's get into the apartment game. So you've seen this a million times on any of my other videos, things that we've done. How do you buy apartments? And it doesn't really matter whether you're buying a 10-unit deal, 2-unit deal, or 100-unit deal. It doesn't matter. It doesn't matter. It's going to follow the exact same 5-pillar method. You have to obviously be able to find the deals. You got to analyze them quickly. Are they a good deal or a bad deal, right? Good deal or a bad deal. And then on top of that, what's your next steps? You have to financing, close, and manage. I don't know why this thing keeps doing that. It doesn't like me. Find, analyze, finance, close, and manage. Those are the 5 key pillars of buying any apartment complex. Doesn't matter where you're at or what you're doing. Small duplex, even up to 100+ unit deal. Okay. So let's go into the finding side. How do you think you find deals? Chime in the chat. Is it on market, off market? Is it going direct to seller? How would you find deals if you didn't know how to really do it? How would you think you would do it? On market, off market, brokers. Okay. LoopNet. Okay. I love it. Build relationships with the brokers. Yeah. Going to the bank and speaking to someone. Yeah, that can work too. People know people that know people. You probably heard me say this before too. The more hands you shake, the more money you make. The more hands you shake, the more money you make. Right? You want to go do all this, go meet a lot of people, create networks. Even if you're an introvert, because I'm, it's funny is I'm technically an introvert. I don't get energy by going out and being social. I get energy by actually being, home with family and stuff like that. If I'm actually in a social environment, I can do it. But once I'm done with that, I get exhausted. I need to reset alone. So even introverts, you can create this environment where you can still network and meet people and shake hands. It's going to be a very powerful tool for you if you're trying to grow in anything you're trying to do in life. Okay. Awesome. So yes, you guys kind of hit the nail on the head with that on the finding deals part. You have the on and then you have the off, right? Some people try and go direct to the seller, which would be in my case, someone like me. I mean, I can't tell you the number of text messages, phone calls, and emails that I get on our properties around the country all the time, from just a random buyer trying to buy it, to a broker, to other people that will send messages saying, hey, you want an offer? Hey, you want this? Hey, you want that? You want this? You're considering selling? You get a lot, okay? You have to understand that it's not that it's a bad method. It actually works quite well. The problem is if you're new to this and you're trying to grow in this, trying to utilize. If you hold on one second, I want to make sure that we are, before I forget, make sure that we are live because we're actually going on YouTube as well. I may not have that stream. Okay, cool. It's going to try Facebook Live and YouTube Live. We'll see if it does it. I don't know if it's doing it, but we'll figure that out. But you have direct to seller, then you have off, and you have on. So the on-market stuff is everything you're talking about. That's LoopNet, that's Crexy, that's CoStar, any of the websites. But if you're really understanding how the game of commercial real estate works, if you're really trying to understand it, you have to realize, let's take the life of a property that's going to be sold. You start here, okay? Nice little multifamily building. Then you get a broker over here. The broker makes a phone call, or 5 or 50 phone calls with their entire team, and they're locking that thing up with the seller, with me. Because for every single phone call I get from a direct to buyer person, I'm getting 5 from a broker, and that broker has 5 people the exact same that'll buy it. I mean, it's just, so would you want 1 or you want 5 offers? So the broker is making the phone calls, connecting it. That broker is going to then move that property when it's ready to go with all the marketing materials. He's going to move it to a pre-marketing status. He's going to go pre-marketing, which means he's going to take his little database of friends, which could be you, and he's going to email it to them, and he's going to text message it to them saying, hey, here's the marketing materials on this deal. It's going to be coming live in a couple of weeks. Why don't you take a first look at it? Let me know your thoughts. That's the pre-market. It's not that it's not on market, it's just pre-market. And why that's important is because that's where about 60% of all the commercial deals in the United States of America will trade pre-market before they ever get there to the websites. Because what happens is if it doesn't sell here, the other 40% will go to the web. And that's where you see the websites like LoopNet. That's where you see Crexy.com. That's where you see CoStar. They're putting them up there because they didn't sell pre-market. So what that tells me is that they're probably overpriced about 95% of the time. That's okay. It's not that they don't sell. It's not that they're not good deals. You just need to know when you're going on there and you're analyzing them, you're going to be working backwards and negotiating hard down. They're probably where they're going to pencil. It's very unlikely that something on one of those websites is going to pencil from day one. You're going to have to back into it and negotiate those numbers. But you want to get access to these guys here before they go here. So then the question is, how do you do that? Well, you leverage these guys. So you leverage the websites, right? You leverage the websites and all those deals on those websites to see who the brokers are in the marketplace that are doing deals, okay? And then from that, you're going to get access to their off-market, pre-market inventory by building a couple of relationships. You could literally take, no different than we did in Kansas City. Give you a quick story. So when we were trying to go out of state, out of market, we were in the Midwest coming from California. So we had to get comfortable with those areas, but I didn't really know them that well. I ended up going to a conference out in Boston and ran into a broker out there and asked the broker, who's apparently from Kansas City, he says, hey, you got to come see this place. And I said, Kansas City? He's like, yeah, Kansas City. So that was in 2018. And I ended up flying out there in January. Before I went out there, I said, hey, I'm going to tour 3 properties with 3 different brokers because I want to get an idea of the marketplace, right? I want to get an idea of the marketplace and leverage it. So I got access to the pre-market deals by meeting a lot of the brokers and touring their on-market inventory. And by touring their on-market inventory, those deals didn't really make sense. That was okay because now I was able to eyeball, give them a business card, shake a hand, right? The more hands you shake, the more money you make. And by doing that, now all of a sudden, I'm getting access to their pre-market. Does this make sense? Am I going too fast for anybody here? Do you understand? Just give a thumbs up in the chat. Does this process make sense? It goes from the broker signing the listing. They go to pre-market first. If it doesn't sell in pre-market, they move it to the websites. 60%, if you were to take 10 deals, 6 of them are selling pre-market, 4 of them are going to the websites. Does that make sense? Thumbs up. Beautiful. Okay. Because that's how it's done, right? And if you want to be efficient with your time, if you're newer into this space and you're trying to get into multifamily, it's real simple. Here's how you do it. You get on Crexy.com, look in your market. I don't care if it's Cleveland, Ohio, it doesn't matter, or Texas, or wherever you're at. In your market, you're going to pull up 3 multifamily deals in the 10 to 30 unit space. You're going to see who are the deals you like, 3 different brokers, 3 different properties. You're going to call John number 1, Joanne number 2, and Suzette number 3 broker. 3 brokers, 3 different deals. Hey, how you doing? Great. Are you doing tours? Awesome. When can you have the tours? Is it a group tour, private tour? What is it? Awesome. It's Wednesday of next week. I'm going to be there. I want to tour the property, talk to you guys, blah, blah, blah. All you want to do is you're leveraging the lure. Go see the properties, tour the properties, get to know the brokers a little bit, analyze the deals ahead of time. You'll probably realize that they don't make a lot of sense. That's okay. Because now you call it breaking bread. Because in that conversation, hey, John, broker, look, I really like the deal. You're at, $1.6 million. I'm underwriting it at like $1.2 million, $1.3 million. I don't know if the seller would consider that, but that's kind of where we're at. And here's why. Oh, well, no, the seller probably wants this. Okay, great. I totally understand it. This deal's probably not going to work. Not a problem, but we are buyers. We're going to buy in the market. We're going to buy in the market. I'd like to buy with you. Can I get on your list of some pre-market stuff? So that way, if you have anything that's maybe pre-market, I'd love to get a look at it. Because that's how you're going to start getting access to the stuff that really makes sense and will pencil from day one. And it's not as hard to make it work, even in today's environment with higher interest rates. Okay, even in today's market with higher interest rates. Does that make sense? Yeah, so great question just came in from Reynolds. Would they ask for proof of funds prior to touring the deal? Not typically. You know, I had a couple people mention that to me, and I was like, that was surprising. Typically, they'll get the proof of funds or ask for some form of proof of funds prior to going further with you in negotiations. But you'll typically be able to see the property, write in a letter of intent, LOI, and then at that point, they're probably going to say, hey, who are you? What's going on? Do you have any money? All that other stuff. So to handle that question on the proof of funds, if you don't have a lot of capital or if you're syndicating your money means you're going to take your money, right? 10, 20, 30, 40,000 in conjunction with other people's money and then the bank's money. And all of that is syndicated together to buy the apartment complex. So when that question comes up, I say, yeah, here's my proof of funds and here's our pre-approval from our bank. We syndicate our equity. So we're going to be raising it as we go through the escrow. Great. So then they're just going to look at a little bit of track record, know you a little bit of it, but there's ways to work through that. And that's why this is the perfect reason. Okay. Great point. This is the reason why you do not go after trying to buy 50 plus unit deals. I hear it all the time from some of these gurus online, and it blows my mind that they're trying to direct their students and people to go after big deals when you haven't done one. I mean, I understand the concept. I mean, the economies of scale and all that. I totally get it. But you have no chance in you know what to get that because of exactly what Reynolds just said. Because then you're getting more sophisticated brokers. You're not getting like the little mom and pop brokers, right? But if you're staying in this space, somewhere in this space, for your first couple deals, 10 to 30 units, you're going to deal with mom and pop brokers. You're going to deal with mom and pop sellers. It's going to be probably less competition as well. So because of that, you are going to be able to get a phone call returned if you're doing it right. You will be able to go see the properties and deal with the brokers direct without dealing with assistants and assistants of assistants and not having to call you back and all this other BS that happens. But if you're playing in this space, you better have done some deals and or the people you're teaming up with have done the deals because it just best of luck to you. This is why you maybe get frustrated. But here you can play ball. The brokers will call you back because they're just mom and pop brokers most of the times. And they're mom and pop sellers. So because of that, you're going to get a response majority of the time. Okay. This is really, really, really important because this is how you're going to play in the space and be able to go see these deals. Because I'm not telling you to go after that. It just won't happen. Not unless you have experience. Okay. Yeah, great question on the proof of funds. Most of the times, I have never had that happen. The proof of funds thing or the whole game on who you are, the financing and all the game is going to happen once you submit a letter of intent and you get a little bit further into the actual process. But touring the deal is like touring the deal. It's like touring a house. It's the same thing, right? They typically will do small group settings, sometimes private, but usually group settings. Okay. Any other questions on that? It's a great question. So that's how you're dealing with finding the deals, right? Finding the deals. You're going to leverage the leverage the on-market website deals to get access to the pre-market deals. And you leverage that through the brokers in the communication, and the shaking of hands and all that stuff that's going to go down. That's how you're going to find deals, okay? There's a lot, I mean, there is nuance to that. What to say, how to say it, why to say it, glossary of terms, like there is nuance. But that's why you learn this stuff. That's why if you want mentorship, there's mentorship. There's all these things you can do to get more detail on it, but that's the high level. Cool. Analyzing deals. Is anybody here scared of analyzing an apartment deal? Does everybody here have a deal analyzer that you can use to look at a rental property? Thumbs up if you do. Thumbs up if you do. And I'm going to go ahead and put another poll up here. This is actually, I'm going to do a question. Actually, I'm not going to put that up yet. Oh. I'm going to stop sharing that one. I'm going to launch this one. This is a question. See if you guys know the answer to this. I'm hoping most of you do. What is net operating income? Is it the net income after all vacancy and expenses are deducted before the debt service? Or is the net income after all vacancy expenses and debt payment is made? Curious. We're like 50-50. Okay. This is good. All right. All right. Coming around. Coming around. Yeah, you're almost right at 50-50. Interesting. So net operating income, just so you know, I'll go ahead and end that poll. Share the results. NOI, net operating income. Go ahead and blow this up. This is equal to, it's the net income, which is, you guys got it wrong. Son of a, just kidding. No, it's the net income after all vacancy expenses are deducted, but before your debt payment. Okay. So it's the net income before your debt. Okay. And I'll break it down just a second. So that way you can understand this. Cool. All right. So analyzing a deal. Every single rental property since the beginning of time, all the way through today, and I don't care if it's a 2-unit duplex up to a 500-unit multi, complex. Doesn't matter. Gross income. We can do that. Okay. Now, there's obviously a lot of line items that are in each one of these kind of large categories. Okay. But gross potential income, meaning what is the maximum amount of potential income the property can make of rents, right? If you're hitting market rents, if you're doing everything perfect, what is the maximum potential gross rent that this property can generate? Then you're going to take out what's called economic loss. Economic loss, and this is actually a funny story about this today. Yesterday, I was in one of our properties in Texas, and I sat down with the property manager, and I asked the property manager, I said, hey, do you know what economic loss is? I mean, you're managing the property. Like, do you know what economic loss is? And they're not taught this, okay? They're not taught this, which is mind-boggling to me when you're running a multi-million-dollar asset and you don't understand. I mean, they understand the concept, but they don't understand the detail. If that makes sense. But they should understand the detail. So economic loss includes vacancy. It includes loss to lease. You can read this. Bad debt and concessions. Okay, that's what that stands for. Physical vacancy on the property. Loss to lease, that's the difference between market rents and what you may be getting. Maybe you're getting higher, lower, whatever it is. I mean, if you're getting higher, that's amazing. That's your market. But typically, it's going to be a little bit less, hence loss to lease. So if your market rents are $1,000 and you're getting $900, you have a $100 loss to lease. So that's what that means. Bad debt, obviously that explains itself. Tenants not paying rent and they get evicted. That's bad debt. Concessions, maybe you got to give in some, 3 months rent, concessions here, concessions there to get people in the complex. Those are concessions. So that is your economic loss. Okay, you have to account for all of that. It's not just vacancy. People think vacancy, they're like, oh, you need to account for economic loss because every property has it. Every property has it. Even, let's take tight markets like San Diego, where we're here right now. Your economic loss number, your physical vacancy in San Diego is probably 2 to 3%. Loss to lease is probably 1%, maybe less than that. Bad debt, probably 1%. Concessions, like 0. So you're at like 5, maybe 6% economic loss in the San Diego market. Okay. Now you change that to, other areas. Let's say you went really, let's say Texas, or let's say anywhere in the Midwest. You could even really take Nevada, Arizona, New Mexico. I mean, you could take pretty much every other state except for the coastal states in the United States. And this is what it's going to look like. Your vacancy is going to be somewhere between 8 to 12% right now in today's market. Loss to lease, you're probably at 1 to 2%. Bad debt, this is going to be somewhere around 2 to 3%. Concessions, concessions are up right now. You're probably at another 2 to 3%, at least. Okay. So you're going to be running right now. I would never underwrite any property outside of California or Florida or the Eastern Seaboard, right? Take the Eastern Seaboard and take the Western Seaboard of the United States. Anything inside those seaboards, I would be running at a 15%, 12 to 15%. So when you take your gross income number and you take out vacancy, you should be using 12 to 15%, because your vacancy is really economic loss, right? If you're going to use one line item for that, 12 to 15% off of that number to get you to a real number. Okay. That's the truth. That's no bullshit truth, because the brokers will come in here and they'll make that OM look sexy. Oh, it's 5%. Bull, you know what? Okay. They're full of it. There's no way they know it. They're just fluffing it up. It's a nice little cloud of fluff. It's not going to happen. Okay. So 12 to 15% is what you're going to see in most markets right now outside of California and the Eastern Seaboard. Okay. Does that make sense? Awesome. So that's kind of on the economic loss side. So let's come back over here. Other income. This is where you make or break your property sometimes. Like other income is like pet income, parking income, laundry income, cable income. I mean, there's valet trash income. I mean, there's all kinds of cool little, there's late fees, month-to-month fees. We literally have like 35 other income line items, because that's kind of where you can, I won't say nickel and dime, but that's where you get a bunch of other income. Because that I'll add into that RUBS. So if you've ever heard the term RUBS, that means reimbursables for utility expenses. Okay, reimbursables for utility expenses. So for water, sewer, other things on the property, the tenants will pay a pro rata share towards that. That's a RUB, a reimbursable to you as the owner of the property. So we'll include that in other income for a minute. So when other says, that's RUBS and other income items. So there's a lot in that, and that can make or break, right? Your properties is this other income line item. That equals effective gross income. So gross income less your economic loss plus the other equals effective gross income. Now, you take out your expenses on the property. Property taxes, insurance, maintenance, repairs, marketing, general administrative, contract services for like lawn care, pool care if you have a pool, and property management fees. All of that's going to be broken down to your expense line items. And then you'll take out also a reserve replacement. What a reserve replacement is for capital improvements. So if you want to reserve some money in case, I don't know, a water heater blows up, the roof falls off, whatever, right? You got to go fix some capital items on the property. You need a reserve replacement to do that. That's what reserves are, okay? But that's all broken into this expense line item. And then you get to this sexy number called a net operating income. Net operating income. Yes, brokers are not highlighting. They put it in the line items. They just make it look sexy, like you don't have it. Yeah. So Ronaldo brought it up. He says, yeah, the brokers aren't showing it. No, because their job is to fluff it, make it look nice for sale. So your job is to keep it real. And that's how you underwrite things correctly. So that's part of the things that when people come in and we analyze deals alongside them, and I'll show you one here just shortly, we keep it real with the numbers, and you can mess them around a little bit, but you want to be realistic, so you're underwriting right. So net operating income. Do you know how you establish value on a commercial asset? Chime in the chat for this. Do you know how you establish value? Like, what is the value of the property? Right? It's not based on comps. Right? It's not like a residential property. So chime in the chat if you know how you establish value for a commercial asset, an apartment building. Yep. Beautiful. Stabilized rents, NOI, cash flow, NOI over cap rate. That is the right one. So yes. So you've heard the saying, if you have two pieces of a formula, you can solve for the third, right? This was algebra when we learned this in high school at some point. So the value equals the net operating income divided by a cap rate. Okay. So typically for a marketplace, if let's say the property, they're putting it on the market and it's not priced. Okay. The broker says, hey, give us a price for the property. And you're like, well, okay, let's figure it out. So what you're going to do is you're going to back into the net operating income and a cap rate to get yourself the value. So the net operating income, you can figure that out from the income and expenses on the property. That'll get you the NOI. The brokers in the marketplace, you can ask a lot of them, hey, what are you seeing for cap rates right now in the market? So for most markets right now in the United States, cap rates, and let's take outside of the coastal zones of the United States, you're going to be 6% to 7% right now. Okay, depending on where your market's at, 6 to 7% cap rates. In some cases, a lot higher than that. But let's just take on average 6 to 7%. So your cap rates right now, this is anywhere in Texas, 6 to 7%. Anywhere in the Midwest, 6 to 7%. And then you get into certain markets, it could be 8, 9%. Okay, but for the most part, 6 to 7% is pretty fair. You get into the coastal markets of the United States right now, you're probably still in the 5s, in some cases the 4s. But, you know, with interest rates where they're at, cap rates have to readjust, right? Because you can't really buy a property typically with a cap rate less than the interest rates. It doesn't work because then you can't cash flow it, right? So value equals NOI over cap rate. So let's say, for example, my NOI was $1 million. And I found out through the brokers and talking to people that the cap rate was 6%. So in that case, it's $1 million over 6%. So that property is worth $16 million. So that's my value. I knew what the NOI was, the cap rate for the market I got from the brokers. So my value of the property was 16.7. And you just back into that. So obviously, based on the financials of the property, you can get to an offer price that's going to make sense based on what the cap rates are on the market. So once again, as long as you have two pieces of the three-piece formula, you can figure that out. Does that make sense? Because that's how you establish the value, okay, on a property. But in terms of analyzing a deal, once again, gross income, less economic loss, plus other income gets you effective gross income. Take out your expenses, you get this beautiful number called NOI. That's how you establish your value. This is the most important number in commercial real estate, right? That NOI, the power of NOI. If you boost that net operating income, even $1,000 a month, I mean, that can add like $250,000 in value to the property. If you boost the net operating income like $1,000 a month, that's $12,000 a year divided by, say, a 5% cap rate. Do the math. Okay, so focusing on that NOI is critical. Then you take out your debt payment to get your cash flow. And this is the number that gets distributed to you, investors, everybody. That's the cash flow after the debt service. Beautiful. So I'm going to go ahead and pull up real quick, since I have it here, a recent deal right now that we analyzed for a mentee. And what was cool about this was, I mean, I was even talking to a gentleman yesterday who just came into the program, and he was, he's in the hospitality business. He's a chef, okay? Chef in the hospitality business, and coming into the program, and he wants the passive. It's typical, right? We all want time, right? Time is everything, right? Financial freedom. We want time. You don't want to work for the man, right? We want to have more control and spend time with family, and then have generational wealth and give back, and all the things that are really important to us beyond going to a 9-to-5 and sitting in a cubicle, or going to a job, or in his case, going to a restaurant and being a chef. And he loves that, but he wants to build this nest egg for retirement, for his family, for his kids, for the things he's doing. He wants that and doesn't just want to sit into a chef job for the rest of his life. He wants to build the wealth. So in that, kind of sending over some numbers and looking at some deals, I thought this was super interesting. So let me share that with you right now. Let me share my screen. 1 second. So I'm going to show the offering memo. And this is a deal that is done with, so I can show it to you. And I'm not giving up anything. So this one's in Texas. And this is an on-market deal. So it's public knowledge. So there's nothing, not showing you that you can't find on your own. They put a price on it. They had a cap rate on it, number of units and so forth. This is an offering memo. So this is what the brokers put together as their fluff piece they'll send to you, and or it's online to download about a potential deal that you're looking at. Okay. And you'll go through it. It has a little summary. It's got some nice photos, aerials. It's going to have what's called a rent roll on the property. It's going to show you all the units and the rents that they're getting, both current and maybe future rents. They're going to show you what they've done to it, renovations. They're going to break. Oh, see, they did the exact same thing right here. Here you go. Exact same thing I was just showing you, right? So gross income. See what they did? They just took vacancy. You see how they put 4%? Did they honestly do that? Did they honestly do that? I'll show you how to really underwrite the property. But anyhow, they put 4% in there. I laugh at that. It's Houston. Are you kidding me? It's probably like 25%. So anyhow, effective gross income, they have it there. Take out your expenses, NOI. So they're giving you that number. You see that kind of breakdown? That's what I just showed you in simple math. Okay. Keep coming through it. They give you projected. This is called a T12. They're taking the last 12 months and giving you a profit and loss statement for the last 12 months. That's what that's showing you right there. It's breaking down income and then month by month by month by month by month. Okay. More photos, interior stuff, all that's great. And then the broker information and so forth. So all awesome info. And then let me show you the actual pro forma. So we have a deal analyzer that you'll get access to. We can give you one tonight with our multifamily toolkit. It's going to have a pitch deck in it, deal analyzer, 90-day guide, bunch of other stuff you're going to get totally free. So stick around for that, and we'll put the link in the chat. You can download that. It's pretty awesome. And that's going to get you some great tools and all the stuff you'll need to kind of get started. So let me pull this up, and then I will share it. So I'm going to share with you his initial numbers that he used, the deal analyzer, and then my numbers. Or should I say our team's numbers? So let me show his. Okay. And I'll try and zoom in a little bit so you can see it. 150. There we go. So we have two deal analyzers. When you're getting started in this, I don't want you getting some crazy deal analyzer that's like a foreign language to you. It's already foreign enough. So we keep it super simple. 2 tabs, nice breakdown. Get yourself a timeline, which is the IRR tab. I'll get to you in just a minute. But kind of walking through the format of a simple deal analyzer that you would use on a 10 to 30, 40, under 50 unit property. Okay, anything above 50 units, you're going to start getting into the more sophisticated stuff. Under 50 units, you can use this. So we give you 2. Anyhow, he put the price in there that they asked for on the operating memorandum. He has a down payment in there of 25%, 28 units. He's got a repair budget. It's a renovated property. You don't need to do a lot. So he's only got 20 grand in there. Totally fine. Got closing costs in here of 3%. He's got an interest rate there of 6.5. You could probably get that today with Fannie or Freddie Mae. So that's pretty good. And then he put in some rent numbers here, right? Unit mix, current monthly rents, square footage, and then future rents. What can future rents do, right? Today versus future. So, and then what is it going to take to get there? Plugging in all your expense numbers over here, both current and pro forma, meaning what can it be? What is it going to look like? Management fees, reserves. We talked about reserves. So all of that, he's plugging all this stuff in, okay? And then come down here and you're kind of breaking it down. So what does the current numbers look like on the property? And then what does future numbers look like on the property? That's here, okay? You see how he's only got 4% in here for a loss and all this other stuff. That's totally fine. We went ahead and highlighted this stuff, sent it back to him and said, hey, take a look at these things, some comments in here. We reviewed it alongside you. Here's how we would look at it. What are your thoughts? Okay. So let me show you that right now. So we came in here and we helped him analyze it when he sent the numbers, and everything in yellow we highlighted. Okay. Let me shoot this and I'll zoom up on it. There we go. So we went ahead and kept the price for now, highlighted his closing costs are going to be higher. Why is it going to be higher? He's going to have an acquisition fee. When you're syndicating deals, just so you understand this, you as the general partner in the deal, you get an acquisition fee for putting it together, right? You're finding the deal. You're doing a lot of hard work. All the stuff you're doing as a general partner to put it together for investors, for yourself, for everybody, you get an acquisition fee of 2 to 3% of the purchase price. Very standard. It's built into your closing costs. So that's why that closing cost is 5%. Okay. We kept the loan amount there, kept the rent amounts because we don't know the rents, but that seems legitimate based on the comps and stuff we looked at. We came over here and we said, hey, we want you to verify these tax numbers because in our case that we understand Texas, we put in a comment there, your taxes are going to be 2 to 2.5% of the assessed value on average. So that wouldn't match up. That should be like 40, 45,000. But I said, verify the numbers. So that way, you know what you're looking at. Same thing with the insurance. Insurance in Texas right now. I mean, it could be 857. That's possible. Possible. But in Houston, I mean, you know what's happening in Houston right now? Those poor people are getting flooded. So that's why we don't buy in Houston. But you're probably 1,500 a unit for insurance. You want to double check that. Repairs and maintenance is way too low. So we put in here a comment. That should be between 650 to 700 a unit based on our math and what's going on there. Okay. Turnover. You're going to have turnover. You need to account for it, right? People are going to move out. You're going to have some turnover throughout the year. That's going to be about $200 a unit. Utilities and stuff, those are all fine. Marketing, we bumped that up. This expense ratio is really low. For this class of asset in Texas, Class C, 1960, 1970 product, if I'm not mistaken, 1955. Okay, 1955 age, that thing's going to run at a 40 to 45% expense ratio. No ifs, ands, or buts about it. Okay, especially in Texas with insurance and property taxes and management fees. They have management fees of 3% in there, not on a small complex like this. I'd be shocked. You're probably going to be around 6% management fees for a smaller complex because it's going to be offsite management because you don't have payroll. So you're going to be at about 6% on management fees on that. So we'd have to adjust that too. We did the vacancy credit loss down here at 12%. That's realistic for the marketplace in Texas, not 4%. But minimum, we put in there 10 to 13. And then coming up on the IRR tab. So what this does, IRR, all it's doing is it's taking 1 year and then it's adding time to it. So you'll see in this case, we did 2024 through 2025 through 2030. Okay. So 6 years, we added time to it. And we want to make sure those numbers line up. But based on this math, I mean, the numbers aren't bad, right? The numbers are not bad. So he's just got to verify this stuff. But you're looking at a cash on this deal of about 8%. That's good. Equity multiple of 2.5%. That's good. IRR of 19%. So IRR, what that means, that's your velocity rate of return. So you have annual rate of returns. If I were to take the total amount of money I make on that property, average it out over the time I hold it, that's my annual rate of return, average annual rate of return. The IRR is internal rate of return. That's the velocity of it. You don't need to know all this mumbo jumbo and get it in granular. This thing does it for you. That's all you need to know. Just plug the numbers in and it does it all for you. And as long as that number is probably in the mid-teens or higher, you're good to go. So just so you understand, when you're looking at deals and you're analyzing deals, these are the metrics you need to look for. You want the IRR somewhere in the 14 to 20% range. Okay? 14 to 20%. You want your cash on cash somewhere between 6 to 10%. And then you want your equity multiple somewhere between 1.8 to 2.0 plus. Those are the 3 metrics I would look at. Because if the property aligns with those percentage metrics, it's probably a fair deal to dive in further and really analyze further. If it doesn't meet that, move on, pass on, go. Okay, so that is really what you're looking for in your deals, in your metrics down there. You notice the ones I highlighted: cash on cash, IRR, equity multiple, because those are your three most important ones. There's plenty of others, but those are the three most important, because that's going to drive a lot of your decision making. Okay, for can I give returns to the investors? Can I attract money on this deal? Just think about it for a minute. The deal will do your raising money part. We're going to get into that in just a second. Your deal will do the raising money part. If it's a good deal, I mean, if I came to any of you that are watching this right now, right? If I came to anybody on this thing right now and I said, hey, I have a deal in Houston, Texas, 28-unit apartment building. It's a $25,000 minimum investment. Based on our projections, you're going to earn about 18% a year on your money. Okay. It's going to be out about 3 to 5 years. And you're going to get about a 2.5x equity multiple on your money. So if you give me 100 grand, I'm giving you $250,000 back. Do you know anybody that may have some interest? Right? You'd be like, shit, yeah. I mean, it sounds like a pretty, I mean, can you send me some information? Great. Here's your pitch deck. So I'm going to send you the pitch deck on the property. It's going to break your investment down, what it's going to look like, your projected returns, all of these things. And the deal will do the raising for you, right? The deal will do the raising for you. It will attract the money. You just need a fair deal that's going to meet some basic metrics and do it for you. Does that make sense? Just put a thumbs up in the chat if that makes sense for you. And then I'm going to do another poll. Got another question for you real quick, because I am curious. What are people's real estate experience that are on this right now? Are you a novice? Have you done a few deals, maybe some flips, wholesales? Do you own a few single family homes? You have a few rentals, SFRs, 2 to 4 unit properties. Maybe you're currently in multifamily. Okay. Yeah, it looks like kind of all across the board. I love it. Beautiful. Yeah, and if you're a newbie, I love it too. I mean, you got to get started somewhere. I mean, my first deal was a $100,000 condo in Murrieta, California in the midst of the financial crisis. $100,000 condo. We put $25,000 down, got a $75,000 loan from Wells Fargo, and that thing cash flowed at like 13%. This was in the midst of the financial crisis, so it was beautiful. Like, we bought that thing so cheap. We sold it for like 300 and something thousand, bought it for 100 grand, sold it for 300 and something thousand a few years later. And then we got into duplexes and fourplexes and stuff like that, and did really well with those. But then we started to realize, gosh, like, why are we playing small? Like, I mean, we were doing all right, but I saw these people doing all these other things and getting these larger complexes, and like, why aren't we doing it? Because we can totally do it. So that got us into kind of the 5 to 10 unit space. And then we realized, gosh, we can syndicate and do much bigger stuff. So that got us into the 20 to 50 unit space, right? Notice I'm graduating. And then once we kind of did a few of those, and I understood the processes of all of those, and they were bite-sizable for us to take down and manage and raise the money fairly easily for deals that made sense, okay? That's what allowed us to then go into 100+ unit deals. You know, and now today we have over 550 units, about $150+ million in assets in 5 states around the country. And we're going to 10,000 and $1 billion. I mean, we are absolutely going there. And we're actually in the process right now, because now's the time to buy. Now's the time to buy. I mean, 2024, 2025, hands down, there's blood in the street. It's a beautiful time to buy. Even though interest rates are higher, they're going to settle. Prices are settling as a result of it. You just got to get in, get granular, and you'll find deals. And get with the brokers and do the pre-market stuff. Use the on-market to get to the pre-market stuff, and you'll do just fine. All right, let's stop sharing that poll for you real quick. Cool. Okay, let's move on. So the raising money part. Raising money, the financing is where everybody gets stuck. So 2 things. As you know, you have debt, and then you have your equity, okay? And I'm going to break a deal down, but I just kind of want to show you this real quick. But I'm going to actually show you how, I'm going to give you a case study of a deal we did. I'm going to break it all down, the debt, the equity, everything, how the money was raised, how we did it, how we structured it, the whole 9 yards. And we'll finish up with that and then open it up to Q&A. But debt and equity, raising that money, like you said, it follows this order: deal, debt, equity. Deal debt equity. If you have a good deal that's going to meet that 14 to 20% and 6 to 10% cash on cash and a 1.8 to 2.0 equity multiple, don't worry about it. If you have no idea what those things are, I know we went over them, but we'll get into granular later. But if it meets those metrics, the deal will drive your money because the bank will throw the money at you. When you are buying a commercial property, that means 5 units or more. Anything 4 units and under is a residential property. Anything 5 units or more is a commercial property. Under commercial loans, they're looking at the property. The property is its own business, right? We went through that. It has income, it's got expenses, it has a net profit. So because of that, the bank is looking at the property's financials, not yours, to get the loan, which is why it's easier to get a bank loan for a commercial property than it is to get a $300,000 home loan. I mean, literally, if the property's financials speak for themselves and give you basic terms and a good return, the bank's going to give you the money. As long as you're not a fraud, they'll give you the money. So it's much easier to do this. But raising the money, and then you come down to the equity side. Well, I'm going to break that down for you in just a minute. So let me get through closing. And I'm not going to touch on this too much tonight because I don't want to run out of time for you guys and be respectful. Inspections, legal, financing, renovations. There's a lot of nuance in closing a deal. So that's where we actually handhold people the closest, is once you actually found the deal, you've analyzed it, you're raising the money, you're like, oh gosh, we're going into escrow, like people will hyperventilate. Like this is where we really come in and hold and wrap our arms around a lot of our mentees and stuff in the programs, because they freak out when they get to this point. They're like, what do I do? We're like, first of all, breathe. Secondly, let's walk through this. So we're going to go through the inspections, both physical and financial, deal with the legal documents, the financing, right, which is the debt, the equity, the loans and all that stuff, deal with that. And then if you're going to be doing any renovations on the property, scheduling and managing that before you close. So that's the closing process. Managing, self-manage or property manage. We don't recommend that. We've done that. You can do that, not a problem. We teach that, but really we teach you how to find good property managers and then manage the managers. Become an asset manager, okay? Asset managers and manage the managers. So that's the management side. Okay. Let's take an example 31 unit deal. And this is an actual deal, okay? Actual deal. $18,000 out of pocket. This guy, 31 units, and I controlled the deal. Let me show you how. See if you can see that. Perfect. So 31 unit deal price, we bought it for $1,525,000. We put $400,000 in reno into the deal. We had closing costs of $225,000. We were all in that deal at $2.15 million. Okay. We got a loan for 70% of that, $1,500,000. We had to bring in $645,000, 30% equity into the deal. So how does that break down? How does this get brought to the table? 10% came from us, me, our company, 64 grand. Okay, 10% of that. As a general partner in the deal, I brought in that. 90% came from friends and family and people. Now, when you say OPM, other people's money, OPM. So everybody gets so blinded about raising money. And you have to understand something. You have to learn how to raise money. I don't care if you're running a taco shop or you're doing anything in life. You have to learn how to raise some money. I don't care if that's raising money from banks, if it's raising money from people, if it's raising money from who flung poo. I don't care. You have to learn how to raise money, okay? You do. So you have to understand that this process of raising some capital, this came from seller financing, a little bit of seller financing, creative, and friends and family. We had some friends that wanted to invest in the deal. Why? Because the deal produced great returns. The deal produced 14 to 20% returns, 6 to 10% cash on cash, right? 2+% on the equity multiple. So people were like, gosh, I can put $25, $50, $100,000 into this and I can get 14 to 20% return on that money every year. Sign me up, Scotty. I mean, so the deal will do the driving for you. So raising that was actually quite easy. We did that with 7 investors, okay? 7 investors came in for that. We got an acquisition fee, okay? We got an acquisition fee for, I think it was it 2% or 3%? I think it was 2% on this deal. Yeah, it was like $30,000, whatever it was, $35,000. At the end of the day, we were out of pocket 18 grand. Okay. Maybe it was 3%. That would make sense. But yeah, it was 3% on that one, because that way with the 64,000 out minus that gave us the 18,000 out of pocket, because you get an acquisition fee of 2 to 3% for putting this deal together based on that. Okay. So that'd be 30,000 or 48, if I'm not mistaken. It was 48. So that's how we got there. Okay. But that is how the deal was actually put together, where we actually only physically had $18,000 out of pocket. So 64,000 goes in, right? The acquisition fee comes out at the close of escrow. It's like Peter to pay Paul. Okay. So your actual out of pocket, right, was about 18 grand. And that is how we had control and ran a 31 unit deal. And we still own that today. The best part about the entire thing, to give you an idea of what you as the general partner get. So people ask, well, why do you do this? Why would you do this? Why? I mean, what's the benefits? Let me show you the benefits of why you do this, because you're the general partner, right? You're the one finding the deals, putting them together, analyzing them, putting it all together. So why would you do that? Okay. Why would you do that? So on this particular deal, in 24 months, we got all our money back. So because I want you to understand the benefits of doing this. So 64,000, we actually put 64,000 in. And yes, we got an acquisition fee out, but our 64 was still in the deal. We got that out in 24 months after we renovated the property and refinanced it. We did a cash out refinance. All that money came back out to us, and it was all tax-free. Okay. We got an asset management fee, and we're still getting it of 1% asset management fee based on the gross revenues of the property every single month. 40% of the profits. So for bringing in 10%, I want you to understand this. For bringing in 10% of the equity, we got 40% of the deal. So it's not like you put in 10% and you get 10%. No, you put in 10%, you get 30 to 40% of the deal, ownership. Okay, so highly beneficial. So that's equating to $2,000 a month. That's $120,000. Then my net profits on the sale were another $470,000 when we refied and did all this other stuff. So at the end of the day, I want you to understand this. You're going to make about $590,000 if you include the cash flow plus the profits, all for $18,000 out of pocket. Now you tell me if that's a good return on your investment. I mean, last time I checked, that's pretty amazing. And this goes over and over and over and over and over and over and over again. If you structure things right and you understand what you're doing and you're taught well, this works. Okay, it works. So that is how you do these deals. So then how would you actually structure it from a legal perspective? People ask me this. Well, what does it look like? Well, you got a nice little apartment building here. It's its own single property entity, LLC. We usually call it the address LLC. So 1234 East Street, LLC. Then it's going to be broken out. You're going to have a general partner and a limited partner, a general partner and a limited partner. You are the general partner at 30%. Maybe it's 40%, right? Either or. It's going to be somewhere right around there. That's you. 70% is your limited partners. These could be the sellers financing the deal. Could be your friends and family. Could be friends of friends of friends of friends of friends of friends, right? All in here. You got your list of people. 1, 2, 3, 4, 5. They're all limited partners. Here's the kicker. Because you're the general partner, you get to double dip. Not only are you getting this 30 to 40%, you also are investing. So our 64 grand was part of the limited partnership. So we were getting our pro rata percentage of the 70% as well on top of that. On top of that. That's why I'm saying it's so awesome once you understand how this works. And you're like, wow. So I just need to find good deals, analyze them. Getting the debt's not that hard if the property's financials work. And raising the money is not that difficult as long as the financials work. So you just need to get a deal where the financials work and let the deal drive the debt, drive the equity. Deal, debt, equity. Make sense? So that is how you're going to structure the deals. Cool. Open it up to questions. Gufran, yeah, I know you have to leave for work. Awesome. Thanks for coming in. See you in the class on Thursday, if you're in there. Yeah, any other questions? We got a good group in here right now. Do not be shy. Let me see. I think I have a Q&A real quick. 1 second. Go back here. And I'm going to launch this last poll. Where do you feel your biggest roadblock is at? Is it finding deals? Is it analyzing them? Is it the financing capital? Closing on them? Management? Just keep in mind, these are the 5 pillars I've been talking about the entire time tonight. Yeah. The financing and capital. Yeah, it's pretty common. It's where everybody gets stuck. And I totally understand why, and it makes complete sense, right? Because we just don't know where to start. We don't know how the power of OPM works. But once you understand that it's all about, number one, network, right? But the deal, then the debt, then the equity, okay? It is very hard to raise money. It is very hard to finance and raise capital, which is what you're talking about, where your roadblock's at. If your deal sucks, it doesn't work, right? You can't fit a square peg into a round hole. So the focus is finding fair, good deals that pencil with the metrics I showed you tonight. Find deals, and we help analyze these things with our mentees, but it's what we do, finding deals. 14 to 20% minimum on your metrics, on your IRR. 6 to 10% cash on cash minimum on that. 1.8 to 2 plus on your equity multiple. If it's sitting in those boxes, you have a good chance that you're going to be able to get a decent deal, get the debt, and raise the equity. Because the pitch deck, especially the pitch decks that we have, do all of the work for you. I mean, it's unbelievable. And you're going to get a full one tonight. I'm going to put up the link real quick, actually. So bear with me for just 1 second. I called so many PMLs, but they don't like the lack of experience. Finding money has been 5-bar the hardest. Yeah. So when you say PMLs, Thomas, what do you mean by that? Am I missing that? PMLs? Private money lenders. Private money lenders. Gotcha. Yeah. Yeah. I got you on that. Yeah. Let's talk about that. Yeah. Let's troubleshoot on that because we can get around that. So definitely let's bring that up too, even on our Thursday calls. And we'll chat more about that because that's definitely something that we can work around. Everybody starts to have those roadblocks, pretty typical in the beginning, but we can work through that. Love it. Great question. Came in from Kevin. How many deals are you analyzing typically before you're finding a good one? Ranges, but 20, 30 sometimes, which is why you get good with the deal analyzer. You start plugging things in, and you can even get it from a high level stuff too on that. But yeah, typically, 20 to 30 would be not uncommon. So but let me get you guys the link for the stuff real quick. 1 second. Stand by with me for 1 second. I'm going to get you guys the link so you can go straight in and get the I'm going to share the results for you on that poll real quick too. Let me get you guys the link. And bye. Check out. Here we go. Okay. I'm going to stick this link in the chat so that way all of you can have it. And then you can get your, put this right in the chat. So that way, go ahead and download the Multifamily Toolkit. If you haven't already, if you have it, great. It's going to have the pitch deck in there. It's going to have a deal analyzer. It's got 90-day kind of guide and stuff for you. Nice little checklist if you're getting started and you're brand new into this. So I think that'd be great as a beginner. Source the new deal. Yeah. Any advice on that for Kenny? Kenny asked the question, as a beginner, do you advise going for deals above 3 million? Depends on the market you're looking in. But if you're in, it's all about unit count too. But keep in mind, right? If you're going after a $3 million deal, all right, let's say it's $3 million bucks, right? I mean, you're going to have to bring in $900,000 minimum. It's probably close to $1 million bucks because 30% minimum on these deals. So if you feel comfortable with that kind of capital raise, right? Or if you feel comfortable, maybe some seller financing and stuff like that, there's ways to work around it. I mean, my first deal, we raised just under $1 million on. So to give you some perspective, our 27 unit deal, we raised just under $1 million for my first ever time, right? The deal made sense. Like I freaked out too. I'm like, oh, I don't know anybody. Because here's the typical response I hear from people. I don't have friends. I don't have friends with any money. Everybody's broke. I don't, know anybody that would do it. I mean, I hear it on and on. And my response to them is, guys, trust me, you're not thinking broad enough. People know people and know people. Do yourself a favor. Get the deal that makes sense first. Put together the pitch deck that showcases the deal. Send it out to as many people as you know. And don't ask them for money. Say, who do you know that may be interested in earning 18% a year on their money based on our projections, blah, blah, blah. Take a look at it. Let me know. You'd be shocked because people know people that know people. And that gets around about a solid deal that makes financial sense. You'd be shocked how that money will find you. It'll be attracted in, okay? But thing being is, as a beginner, if you have a decent network, then yes. If you're limited on your network, then you want to stay reasonable on your capital raise, right? Your capital raise should probably be somewhere in the 300,000 to 500,000 range, right? When you're raising the money, you want to kind of be sitting in there for your first one, which is once again why we say 10 to 30 units. And realistically, you're probably going to be for your first one, 10 to 15, maybe get to a 20, but you're going to be somewhere in that pocket. I mean, I look back at like kind of all our current mentees and everybody that has done the deals and where they're at, and they're all kind of in that pocket zone for their first deals because that's what makes it's enough scale, makes financial sense to bring in investors and capital and money and people and things. It's not too big where it's, it's bite-sizable for them. And they can make it happen. So that's kind of where I would focus. And there's enough properties in that space to do it. There is. So that would be my recommendation, especially on your first deal or two. And then you'll scale on that. Also, if any of you guys have any interest, and I know Kevin and Shai are here in the chat watching it. If you guys have any interest in chatting about learning more, right? If you want to, I don't know if it's mentorship you want, if it's learning more about courses, we have all kinds of stuff. If you're just trying to learn this stuff, but to get into it, I'll put this in the chat. You can go ahead and set up a free strategy call with our team and chat just to see where you're at. No high pitch sales stuff, none of that. It's just where you at, where you want to go. Can we help you or not? Because ultimately what we're doing, just so you understand from a big perspective. So everybody understands kind of my vision, okay? My vision. And this is what we are working very hard to create, is a community of well-trained investors, right? That are doing deals around the country. That's why we have the community chat. That's why we're trying to keep it very intimate. That's why I'm making sure people get access to me and our team and all that stuff to kind of create a nice intimate experience for people and create a very vibrant community of people doing deals, because partnerships in deals and collaboration and all of that is how you do this. You don't do it alone. It's very, it's not that you can't, but we're trying to get to 10,000 units and 1 billion. We're not doing that alone. But by leveraging a great network of people, you guys could find deals that we may not see. I'm talking to a couple of guys right now and actually analyzing if they're on here, Hayden and Matt. They sent me a 512 unit portfolio in Oklahoma City, right? They could never do that deal right now themselves, but they said, hey, why don't you take a look at this thing? And maybe you with us, we can come into the deal. I said, heck yeah, you found it. So if we do it, you'll just come into the deal as a piece of the general partnership. Now you're going to get access to a 512 unit, 3-property portfolio in Oklahoma City all day long. So go find some other deals. We would love to partner because it's about this. It's about helping others, giving back, leaving a legacy, creating an awesome community of well-trained investors where everybody's making money and everybody's getting rich. Because if you're winning, we're winning, everybody's winning. And that is the big picture behind it. It's not about mentorships and courses. That is a piece of the pie to get to this. Because we know that if we can create this, we can get to 10,000 units. You can get to wherever you want to go. Everybody wins. Everybody wins. And that's what we love. So I hope that makes sense, because that is kind of what I wanted to end on this evening. Let's partner, baby. Let's partner, because that is the big picture behind it. So everybody grows. Yeah, so click on that link if you want to set up a call or anything like that. It should be in there. You do not see it. Well, that's odd. It should be in there. Do you see it now, John? You don't see it. What in the world? Host. Oh, that's why. It was only sent to the panelists. That's weird. Wonder why I did that. Should go to everybody. I will reset that. 1 second. Stand by. Here we go. To everyone. Now it goes. There you go. Yeah, love to chat with you. You know, if you're looking to do whatever you want to do, we want to help. We want to help. So, and it's a very intimate experience, and that's why a lot of people are coming in, and we're trying to help everybody as best we can. So, we'll send the toolkit too. 1 second. Yeah, thank you for sharing that, because I didn't realize it was not sending it to everyone. So now it will. Stand by. Un momento. There's the toolkit. You'll love it too. It's a great little starting point. Get into it. It's got your ebook in there, free deal analyzer, free pitch deck, 90-day action plan guide for you, some kind of just starter stuff to get going. And love to be a resource for you if you're looking to do this. Did I miss some questions? Ronaldo and John. Did I miss you guys? Hold on 1 second. Let me scroll up. What was the questions? Oh, Ronaldo, great question. Can you do this alongside with a full-time job? 100%. Yeah, let me give you an example. What I did. So I was a real estate agent. Okay, 9-10 hour days, right? Rocking and rolling in Southern California. I do my job 9 to 5, come home, I had family, kids, all that stuff, do the family thing, put them to bed. 4 to 6 hours a week. 4 to 6 hours a week. You can absolutely get started, execute, and have success with it. So, because I was doing a couple hours, maybe an hour or two a night, 8 to 10 at night, looking for deals, analyzing them, looking for deals, analyzing them, looking for deals, analyzing them, and then you find a couple that make sense. You move the needle at that point. So once you get like 1 or 2 deals under your belt, like you're going to double dip and kind of side hustle, right? Until you get a couple deals. And then at that point, you're going to see some cash flow. You're going to see some stuff coming from it. And now you can start to decide, well, do I need to work as hard on this other 9 to 5 job, or can I start pulling back from it? And then you get to a point like I did, you make the full transition, right? Once that income starts to overtake, you make a full transition. So 100% you can do that. And then VJ had a great question. How easy is it to get people to invest into a deal? I think I answered it in an odd way, but direct. It's not hard if you have a deal that makes sense. The deal will drive the money. The deal will drive the money. Okay, trust me. I know people get so bottlenecked with that. I can't do it. I can't. Yes, you can. Yes, you can, and you will. You will. Okay, let's get a good deal that's going to make some sense. Analyze it correctly. Get the pitch decks going. Trust me. People know people that know people, and you're not. Keep in mind the OPM game. Other people's money. That could be seller financing. It could be private lenders. It could be friends of friends of friends of friends. Right? It could be us on certain deals. We will look to partner. So all the above. Just what I would recommend, like I mentioned before, is not going too big on your first one, so it's bite-sizable. $300,000 to $500,000 of capital raising is very doable with about 3 to 4 people. Like you'll raise that with about 3 to 4 people in your deal. Okay. Another question from John. Do you always put 10% into your deals? Yes. Except when it gets to a really big deal, maybe 5%. Because then you're talking big money, right? If you're doing a $30 million deal, you're probably not putting in 10%. You may be putting in 5%, and then you raise the rest. So, yes, Kevin, multifamily school does have that. That's a cool part of the chat and the community is we actually have already seen it happen where we had some mentees pitch a deal and we had other mentees and people in the program say, hey, I'm actually curious. Let's invest. Let's look to invest. It was a $25,000 minimum. So I thought that was great. Love that. And we want more of that. Beautiful. Is it best to look for deals in your area that you live? Yes, if you're outside of California and New York. If you're in California and New York, you need to invest out. And let's keep it straight up. And that's what we do. So you should too. It's not because they're bad states. They're beautiful states. They're just with the crazy tax laws, and then you get the landlord-tenant laws and very tough business environment. You know why. That's why we have to, unfortunately, have our dollar go farther out of state. Oh, legal documents, John, great question. So as part of the mentorship, when people come in, you get access to all our vendors and systems. So we have 3 different attorneys in the back end of our system. It ranges anywhere from about 7,000 to 13,000 for your first set of documents. But keep in mind, every time you do it, at least with our guys, it gets cut in half. So your first set of documents will be that much, and then it actually goes down, down, down for every other deal. That was the legal documents. John was asking for the cost of legal documents to structure deals like this, 7,000 to 13,000, and then it drops each time you do them more because it's like templated. Best state to set up an LLC, Wyoming or Delaware? Wyoming or Delaware? Wyoming or Delaware? That's it. Perfect, perfect. Okay. Any other questions before we jump off here? Love it. Got to go. Thanks for coming, everybody. I see that in the chats. This was awesome. It was fun. This is recorded. We will put this up. So if you want to rewatch it, you can do that as well. But this was a lot of fun. And we will be doing one next Tuesday too. So if you want to chop in or hop in, we're going to kind of do these live Q&As like this on Tuesdays and help people out. You know, if you want to bring deals to the table, bring deals to the table. Let's talk about them. We'll bring them. I'll bring you right up on screen. Next week, we'll start bringing people up on screen, and I'll have you kind of go through deals and have a lot of Q&A. But this one was kind of the first one we're doing here on Tuesday nights. So we'll have better opportunities next week. I won't have to go through all the detail again, and we could just start looking at deals and we'll analyze them. And that way you can throw all kinds of stuff at me and I'll help answer them and I'll analyze the deals right alongside you. Okay. So beautiful. Everybody have a great rest of your night and we'll chat soon.